We're live. Hey, everyone. Happy Wednesday. I know just a few more days left in 2020. So I am super excited to have Jonah Lupton with me today doing a Facebook Live. Thanks so much for coming on today. I appreciate it. So before I ask you, tell me a little bit about yourself. I'm going to tell people that, you have almost 500,000 followers on Twitter. You are super active on it. I follow you. You've got a great following. But more importantly, the content that you put on there is amazing. You're talking constantly about stocks that a lot of people haven't heard about. You're talking about things that growth companies that a lot of people don't even have on their radar. And you've got a newsletter out there that you've been emailing people about some of these growth stocks that I'm like, shit, I haven't heard about some of these companies, and I want to research more. So yeah, welcome to the show. Tell me a little bit about yourself. First of all, I have to ask you, how do you manage your schedule? You've got so much going on right now. It's absolutely remarkable that you're active on Twitter. You're talking about all these growth companies, doing all this research, running multiple different other companies. How do you do it?
So first off, well, hi everybody. So my name is Jonah Lupton. I guess one way I do it is I don't really have any other hobbies right now, and since because of COVID and the pandemic, it's not like any of us are traveling or going to social events or hanging out with friends. So, it's basically sit at home and do this sort of stuff all day, go to the gym for a couple hours while I wear a mask, and then go to sleep and trade. Like, that's basically been my life for the last 7 or 8 months. So, and that's one reason I'm trying to get this new project off the ground, which would be a shared office space for other full-time investors and traders, because I think once this pandemic is over and we all get the vaccine, or we all have, herd immunity, I think a lot of us are ready to get out of our homes and away from our home offices. Staring at a screen all day by ourselves gets kind of lonely. So, I don't know where the first location would be, probably either Boston, where I'm from, or maybe down in Florida. But if I can find 15 or 20 people in that area that would like to spend most of their, Monday through Friday days around other investors and traders, I think you could, build a nice little community. So that's my newest project on top of the other stuff that I'm doing. Like you said, the newsletter, this valuation model that I have now that I've been building for the last 6 or 7 months. And I finally hired a developer and talked to 12 or 13 different data providers, and finally found 2 or 3 data providers that have the data that we need for the model. So that'll be going live sometime in January after we finish, coding the whole model out and then plugging in all the feeds and testing it ourselves. So yeah, I definitely stay busy.
That's awesome. That's great to hear. In terms of the markets, when did you start investing? When did you say, hey, I'm going to go buy these individual stocks? Of course, we're going to talk about your performance in just a minute here, but how long have you been an investor?
So I graduated college in 2002, so right at the end of the dot-com bubble, and I went to go work for Morgan Stanley right out of school. So I jumped into it, at 22 years old. Didn't know much. Obviously, when you get into that industry, you learn a lot as you go. It's not stuff that you can learn in school. So I worked at Morgan Stanley for a couple of years, building up my client base, wealth management, whatever you want to call it, private client group. Then I got recruited to Smith Barney. So I was at Smith Barney for a few years. And then I got recruited to a private trust company out of Boston. I was there for probably 5 or 6 years. And then in 2011, after the financial crisis had ended, I was just so burned out. I don't know how many people remember that financial crisis, but it was 10 times worse than what March was. March was like straight down and then straight back up. The great financial crisis was just like 2 or 2.5 years of just like steady declines. The bankruptcies were out of control. The job market was horrible. It was just depressing. It was so depressing to be part of that and trying to run client money during that 2 or 2.5 year stretch. So when it was over, I just needed to do something else. So I got into the tech industry or the startup industry. So I did a bunch of startups. I started e-commerce companies, started a media company or a development company. We were building mobile apps for ourselves and other clients. I launched 3 or 4 other projects. And then in 2016, I was living in an apartment in North Carolina and I could hear my neighbors on the other side of the wall. And I figured, okay, there's got to be an easy way to soundproof these walls. And I did a bunch of research, talked to my landlord, called the GC, and the only way to really improve the walls is to rip them apart and start all over. And I thought, well, why doesn't someone just create a paint that you can use to, reduce the sound transmission? So I spent the next year with my chemists developing a paint that you can spray on the wall and it reduces the sound transmission, what we call soundproofing paint. So I've been building that company for the last 3 or 4 years, took on some investors. We got approved by Sherwin-Williams and PPG as vendors, which is a pretty big deal. PPG has 2,000 stores, Sherwin-Williams has 4,000 stores. And I thought I was on the way to building a 20, 30, $40 million company. And then COVID hit and just destroyed us, because we were focused on the hotel industry and getting our paint into these big hotel renovations. So there's 60,000 hotels in the US and the average hotel renovates every 7 or 8 years. So every year in the US, there's literally thousands of these hotel renovations going on, which is the ideal time to use our product. So we had a whole bunch of these projects lined up for this year and next year. And now we just don't know what's going to happen because, hotels are having such a difficult time financially that the last thing on their mind is, spending millions of dollars renovating the property. So as, I had my own portfolio the last couple of years. I never put a ton of time and attention into it because I was spending 50, 60 hours a week on SoundGuard, traveling all over the country. I was literally living out of hotels 2 or 3 weeks out of the month.
Wow.
3 or 4 flights every week, flying from Chicago to Denver to Seattle to Vegas. It was just nonstop. So the last thing I had time to do was sit in front of a computer all day and manage my portfolio. So I was more of a buy and hold guy back then. And then when the pandemic hit, everyone's working from home. I'm not spending much time on SoundGuard. That's when I really started to put more time and energy into my portfolio. And now it looks like I'm getting back into the industry full time because this is what I love to do. This is what I'm the best at. This is where I can make the most money. I can help the most people. So I'm definitely doing a few things in the industry right now. I don't know if that means starting my own RIA or joining another firm or launching a hedge fund, but something I do to keep me in this industry for the next 30 or 40 years, hopefully.
Yeah. Let's pivot from there. What you just talked about, the financial market, the Great Recession. I remember back then I was sitting in my pathology class and I'm looking at Lehman Brothers just going down in flames. And I'm like, wow, this is just something that you would never expect to see from a big firm like Lehman Brothers. All these companies, Morgan Stanley, JP Morgan, Citi, these guys are just getting to a point where they need a lifeline to survive.
It was, AIG needed a massive lifeline. Washington Mutual essentially went bankrupt and had to get bought. Lehman Brothers went out, they got bought. Bear Stearns went out, they didn't get bought. It was ugly. The mortgage, I remember Countrywide Mortgage. They got snapped up by somebody. I kind of forget who bought who, but I know Bank of America bought Merrill Lynch. Merrill Lynch was in trouble. That was a very, very crazy time. And to be in the industry, managing money for clients, not really knowing where to hide, because clients are still paying you to manage their money, and you can't just hide in cash with all of it. Right. So it's like you feel compelled to buy something or to pick a side, whether it's equities or fixed income. But everything was getting hammered because even the bonds were getting downgraded, and in preferred stocks. It was just an absolute disaster.
It was. And I remember back, and not even too long ago, in February when the market was making new highs, the conversation wasn't so much about COVID. It was about what is going to be the next financial crisis, what's going to, take this market down. And there was a lot of talk about commercial markets, commercial lending. There was a lot of talk about student loan debt crisis that's going to possibly hit the markets, and that's going to be the trigger point that's going to bring the markets down. And all of a sudden, COVID hit, and you just said, the markets just went from, their all-time highs back in mid-February to basically 40% down on the SPX by March 23rd. And then no one really saw this coming when the market started to take their uptrend, and it was truly a V-shaped recovery that a lot of people have been talking about now. I mean, you can look back at the charts and you're like, wow, this is just absolutely amazing, but it doesn't mean that the financial situation of a lot of these companies have improved. I mean, there are still companies that are struggling. They're not making any money. They still have no clue how they're gonna come out of this with the amount of debt that they have on their balance sheets. So you're right. I mean, there are companies that have excelled and made 100, 200, 400, 500% returns this year. I mean, there are companies, for God's sake, that are up 100 to 200% in a month.
Yep.
But where do we go from here? What's your outlook on 2021? I mean, it's not going to be as easy to make money in 2021 as it was this year, right?
I would definitely say no. I mean, nobody knows exactly what's going to happen next year. I mean, I could build a list of reasons why the market grinds higher, whether that's 10, 20, 30%, zero interest rates. So for these big fund managers, the foundations, the pensions and whatnot, what percentage of their portfolio or assets under management can they afford to put into the fixed income market at 0% rates? The answer is not many. So if that money is going to stay away from fixed income and just keep sliding into the equity markets can keep grinding higher. But at the same time, I mean, I feel like there's been a lot of damage done to the economy, especially the small business industry, the restaurants, the hotels, I mean, the movie theaters, the gyms, the salons. I mean, all these businesses have taken just a beating. But at the end of the day, I mean, they're not publicly traded companies. So I don't know if the market is ever going to care about the small businesses, which is unfortunate, but it's just the truth. So I'm not sure. I mean, for me personally, I did get sucked into the value rotation back in like May or June, where we made, the growth stocks, picked up a bid in late March, started to rally, and then I forget when we started to get vaccine news or, the trials are starting. I almost forget what started the rotation into value. But, after a couple of days of watching my growth stocks get hammered, of course, I fell for the carrot and I started to chase some of those value stocks. And then, of course, a few days later, they started getting hammered as money rotated back into growth. Right. So at that point, I learned my lesson. That scar was bad enough where I had to then buy my growth stocks back at higher prices in some cases. So I decided to just stick with growth. And at any point through the course of the year and through the pandemic and any vaccine news that we might get, whenever the market started to rotate out of growth into value, I would just buy more of my stocks. But hopefully, I was trimming along the way. So I'm probably more active than the average person. I'm certainly not buy and hold. I'm not married to any of my stocks. I mean, I trimmed Tesla today. Tesla's been one of my biggest positions for the last 5 or 6 months. But I mean, at this point, the stock's up 700% on the year. They've already been added to the S&P 500. Anybody that was going to buy the stock and front run that exclusion has already done it. So I just don't think there's a lot of net buyers left in the market to bid Tesla up past these levels. I still like the company, so I still own it. But I mean, I've, over the last month and a half, or let's say not even month and a half, over the last 2 weeks, I've, trimmed back my position from what got as large as 15%, right when the inclusion was happening, or I guess maybe a week before the inclusion. And now it's down to, I'm just looking at my portfolio, 4.6%. So, and that's not, I mean, it's nothing against Tesla or Musk or their products or anything else. It's just when a stock is up that much in a year, you have to look 6, 12 months forward and try to decide how much more upside is left for this stock.
Right. So you're saying that you're not necessarily getting out of Tesla fully, you're still invested, but you might go back into it. I mean, if Tesla, has a drawdown of 20, 30%, you might want to get back into it.
I would, so I trimmed it today at 645. I trimmed it. So I got lucky. I actually sold a big chunk of Tesla last Friday afternoon, rated to close for 695. I actually put in some orders for 670, 680, and somehow they went out at 695. If I had known they were going to go out at 695, I probably would have sold every share that I own, because I just don't think there's a lot of upside left for Tesla over the next 6 to 12 months. I just think they're going to have to sort of grow into this valuation and prove themselves, because a lot of this performance is not based on the fundamentals. It's based on 5-10 years down the road, the entire total addressable market of EVs going from 3% to 30%, hoping they can keep 30-40% of that. So, I mean, it's still at this point, at this valuation, 600 and something $billion. I mean, to me, there's more risk than reward right now with Tesla. So I would rather look at my portfolio and see, okay, what stocks in my portfolio do I think have the most upside over the next 3 to 6 months? And that's where I'm going to put my money. That's where I'm going to overweight my positions. So, today I not sold, but I trimmed my Tesla. I trimmed my Fiverr. I trimmed my CrowdStrike. I trimmed my Square. When I say trim, this is anywhere from 5 to 15% of my current position. Right. So, it's taking a stock that maybe was a 7% weighting in my portfolio down to 6, or 6 down to 5, so it's not a complete dump, but just trimming it back and then adding to some of the stocks that maybe had a rip higher a couple months ago, and now they've pulled back 20-25%. They started to form a base. Maybe they're sitting on one of the averages, and now I feel like they're ready to take the next move higher. That's where I would rather, trim the stocks that have already had the run and jump into the stocks that might be about to run. So that's how I manage my portfolio. Stocks don't all zig and zag at the exact same time. Right. Some are ripping while some are dipping. Some are hitting their peaks and some are hitting, their valleys. And so that's where I'm constantly moving money around in my portfolio. And for me, it works. And to be honest, I think that's the strategy that's going to be the most successful in 2021, where, we have a much choppier year, and you're going to get more of these rips and these dips based on economic news or interest rates or trade wars or whatever else.
In your opinion, do you think in 2021 we might see a second drawdown that could be as big as what happened back in March?
I doubt it would be that dramatic, because obviously what stimulated the drawdown in March was the COVID and the shutting down of the economy and not knowing how long it was going to last, and not even, thinking that a vaccine was still a year away or 2 years away, right? I mean, people were saying it could take 2 or 3 years to develop a vaccine. And we ended up, these guys ended up doing it in 6 or 7 months, actually they developed it in like 3 months, and then they had the trials for 3 months. So, I think everything in terms of vaccine has been ahead of schedule. So I don't think we would get a drawdown based on COVID at this point. Moderna and Pfizer have already come out in the last 24 hours and said that they think this new strain of COVID that they found in the UK, they believe that their vaccines would also be effective against that new strain because of how it attacks the protein spiking, that stuff's over my head. But I'd be shocked if we don't get at least a couple 10% pullbacks next year. Right. Maybe we get a 10 and a 15, maybe we get a 10 and a 20. I don't think we get a 30 or 40, not with 0% interest rates, not with, the Fed and the Treasury, being super aggressive with their bazookas and their cash creating machines. So, with so much capital in the markets and so much, literally trillions of dollars sitting in money market funds or short-term treasuries waiting to be put into something, I just think that any 10% dip would get bought up pretty quickly, unless there was like some really catastrophic event, that hit the economy, or maybe a different virus. God forbid, right? Something like that. I do think the economy is more sluggish and more damaged than people want to, give it credit for. Maybe that's not the right way to put it. When I have friends in commercial real estate, that are scared to death about 2021 and 2022, because there's just a lot of, if you look at the numbers, the real estate numbers for New York, for Boston, San Francisco. I mean, they're at historic highs for occupancy. Not just in commercial, but also residential. I mean, they're putting up these luxury buildings all over the country, and I'm not sure who's going to live in them anytime soon, because it seems like more people are, moving to the suburbs and, want to live in single family houses now.
So do you think that the commercial real estate market could be the next trigger that could, bankruptcies related to real estate? Obviously, like, there's still a lot of people that are not paying rent. There are a lot of people that, basically have that leeway of not having to worry about that. But come January, in next year, in the next 3 or 4 months, they're gonna have to make a decision. Do you pay all that back rent, or do you go through a bankruptcy process?
I agree. I thought I heard a number the other day on CNBC, which almost sounds hard to believe, but based on how many people live paycheck to paycheck, it's probably possible. I've heard that something like 25 or 30% of all Americans don't even have $1,000 in their savings account.
Mm-hmm.
And I thought I heard on CNBC that if this stimulus package didn't go through at something like $1,600 a person, and obviously you might even be lower than that right now, but even if that stimulus package didn't go through by the end of January, something like 10 million Americans couldn't afford to pay their mortgage or their rent. So, that's a scary number, and you can't just keep kicking that problem down the road. At some point you need job creation, and
exactly.
I don't think the hotel industry is bouncing back as fast as we wanted to, or the restaurant industry or the travel industry. So
now
I'm worried about that stuff. I just don't know. I don't know. It seems like the markets have overlooked all of that for the last 6 months. So I'm just not sure if they're going to start to care, or they're just going to keep overlooking it.
Right, exactly. And I think, that's part of the next thing that I want to talk to you about is when you look at some of these growth stocks like Zoom, DocuSign, Peloton. The big argument is that, yes, these companies have been up 2, 3, 4, 500%, year to date, because a lot of that demand was pulled forward. But that's not going to be the case in 2021. What is the argument for, companies like DocuSign, Zoom, Peloton, that growth will continue?
Right. So Zoom, I've been out of Zoom for months. I got out of Zoom too early. I got in at 120. I got out at 250. I think I got back in at 300, and then I got out at like maybe 400 or 450, and then I think it rallied up into the 500s. Right. So, because I thought that investors, even though we all knew Zoom was going to put up a monster third quarter number and probably even a fourth quarter number, I just assumed investors would already be looking forward to 2021 and say, okay, they pulled all this demand forward. There's no way that they're going to see anything close to that growth again. Some of it is going to stick around because some people are going to keep using Zoom. Some offices will close and employees will only use Zoom and they'll be remote, blah, blah, blah. Mm-hmm. But the market, Zoom just kept on rallying. But now that we're at the end of 2020, I think some investors are finally looking to 2021. I just did it a little bit too early. So I have no interest in Zoom right now. I am strictly looking at 2021 numbers and even early 2022 numbers to really come up with like my 12-month price targets. So for Zoom, for instance, so I think last time I checked, Zoom was about $120 billion company. I think they were projected to do about $4 billion in revenue next year. So that's 30 times sales. Now, I know they have good gross margins. I know they're profitable, but still 30 times sales is no joke. And my first rule of thumb, so I have a whole bunch of rules when I'm valuing companies, depending, trying to decide when to get in, when to get out, when is the stock too cheap, when is it too expensive. If it can't pass this first test, I don't touch it. So it can't be trading at more than 50% of its revenue growth. So if Zoom is projected to grow at 40 or 45% next year, let's just say 40% year over year, then I'm not willing to pay more than 20 times sales. So that's just my rule of thumb. And that goes for pretty much every growth stock. Now, I'll break the rule sometimes if the gross margins are really, really strong or they're already profitable. But a lot of these high flying growth stocks that are trading at 50, 60 times sales, I'm not touching them unless they have the growth to support that. Like for instance, Snowflake came public a couple months ago. Snowflake was growing at, 130% this past year. And that growth is now going to slow down to, I think, 80 or 90% for the next year, which is still great. But the stock is trading at or it was trading at 100 times sales. So,
Exactly.
I don't mind paying 50, 60 times sales if they're growing at over 100%. But if growth is going to slow down over the next 4 quarters or 12 months, if the growth is going to slow down to, let's say, 80%, then I'm not paying more than 40 times sales. So
Right. I love that tip, actually. That's a good one.
it keeps me out of trouble. Now, of course, just because a stock looks expensive doesn't mean it can't get more expensive. Amazon always looked expensive. Apple for many years looked very expensive, Nvidia. So, but like within reason, what used to be expensive 5 or 10 years ago is now like off the charts expensive, where, the multiples that some of these companies are trading at, based on their growth just blows my mind. When I see someone paying, like I think Coupa was one of them that I looked at recently that I just can't understand why people are willing to pay 30 times sales for a company that's only growing revenues at 25%.
Right.
As soon as we start to see this correction at some point, those are the stocks that are going to get hammered the most. The ones that are selling at the most outrageous multiples without the growth to support that multiple, they're the ones that are going to get just destroyed in this market. So of course, all growth stocks will get hurt, but to me, the ones that have the most outrageous price to sales multiples are the ones that will draw down the most. So, but I'm also, most of my portfolio, so it's a pretty diversified portfolio. I'll just go through a couple of the top names. So C Limited, right? Based in Southeast Asia, e-commerce, digital payments, online gaming. That's still my biggest position at 7%. My second biggest position is Teladoc, so telehealth. And then my third biggest position is a company called Futu, which is a sort of like a Robinhood or an E-Trade or Charles Schwab based in Hong Kong. So, they're more or less like a mobile trading platform like a Robinhood, going after the millennials. And I just feel like that company is going to explode. It's been a little bit painful the last month because they rallied up to about 50 after their IPO, and they've now pulled back to like 40, 41. And I got in sort of in the middle of the pullback, and because I didn't want to try to pick the bottom perfectly. So I don't mind getting in a little bit early before it bases, and then I'll just keep adding through the base, and then hopefully it bounces off an average and rallies higher. And this one sort of did that it based, came up 5, 6, 7%, and then dropped down below the moving average, which always makes me a little bit nervous. But I don't know, sometimes with a new issue company with a small float, you never know exactly what's going on. And then DocuSign, which you mentioned earlier, so I still love the company. They're still growing at 40, 45, 50%. They've done a couple really smart acquisitions in the past 2 quarters, so they're getting into like smart contracts, which are so AI powered contracts. And then they're also getting into what is it? I forget. You used to have to go to a bank and get stamped, right? Notarized.
Oh, notary.
Yeah. So they bought
I read about that.
Yeah. So they're getting into notary services, which is really smart. So, that's a 6.2% position. And then my 5th biggest position, which I've just added over the last few days. So, you mentioned earlier my newsletter, which goes out a couple times a week. Each time it profiles a different stock. I do try to stick to the smaller companies, these undiscovered hidden gems that maybe most people haven't heard of before, or no one's really talking about. You're not going to see these companies mentioned on CNBC, but they're still doing some good stuff. They're putting up big numbers. And these
are companies that are like what, under $1 billion or even less than that?
No, so Mohawk's under $1 billion. I might go as low as 100 million, although I just think based on the number of people that get my newsletter, I do think that we have the ability to move the stock. which makes me a little bit nervous on a really small company. So, I mean, Mohawk's about 275 billion, maybe 300 billion after this, the move in the stock the last couple of days. But I mean, if anybody's interested, you can go to jonahlupton.substack.com and you can read my in-depth analysis on the company. So when I put these newsletters together, I usually spend 5 or 6 hours doing all the research and due diligence, listening to conference calls or reading the transcripts, going through the investor presentations, reading any analyst reports that are out there for the company, just even going to Twitter and seeing what people are saying about the company. And then in some cases, just because these are smaller companies, sometimes the founders and CEOs are more accessible. So I've actually had discussions with both of the founders of the company, just to get their opinions on what the company's doing and what the next 12 and 24 months might look like, their expansion plans. And I just became very comfortable with the company. And I just think this is one of those companies that has a chance to, potentially 10x over the next 3 or 4 years.
Wow.
Just because of everything they're doing. So their strategy, so they are there's a couple different strategies. So they built a proprietary AI platform that looks at all the data across the Amazon and Walmart marketplaces and tries to figure out where is there a lot of demand for certain products that's not being met on those marketplaces because either there's not enough high quality products or there's just a lot of bad reviews on the products that are available. So they take that information and then they go to their manufacturers in China and design a higher quality product and start manufacturing it and shipping it within 6 to 8 months, which is very fast.
So is that based on like a keyword research, like search, what somebody's typing in that they're looking for such and such product and the search results are not really popping up?
I'm not exactly sure. I mean, how their AI is, their algorithm is built. I mean, I know they spent a couple of years doing it and they have a whole bunch of software engineers and data scientists on the team that developed it. But yeah, it's probably something like that. I think there's APIs in those marketplaces, but which is actually a little surprising. I'm surprised that much data is public, and I'm assuming that it is public, that they're not finding some illegal way to obtain it. But so they're developing their own products, their own SKUs, and launching them on those marketplaces within 6 to 8 months, which is very fast. They have a very agile supply chain. And then they're also making acquisitions of other companies that also sell in the marketplaces where, because if you're a consumer products company and you're doing $8 or $10 million a year in revenue, you don't have a lot of exit opportunities, right? I mean, Procter & Gamble is not buying a $8 million company.
Right.
Unilever is not buying a $10 million company. They're just too small. So a company like Mohawk can come in there and make these smaller acquisitions and build, sort of a mini-sized Procter & Gamble conglomerate that sells across these different platforms. So Amazon, Walmart, and then they have their own Shopify store for each of those brands as well. And now they're starting to expand overseas as well. So it's just an exciting company to watch. It wasn't on anybody's radar. Not many people are looking for these smaller companies. They're, I think if you turn on CNBC, you get plenty of interviews and whatnot from the CEOs of Boeing and Starbucks and Walmart. But I mean, to me, I just have no interest in owning those companies. I'd rather try to find the next Boeing, the next Walmart, the next Amazon, etc. So, and then, other growth stocks I own are, Square, CrowdStrike, Etsy, Fiverr. But I mean, these were much larger positions for me over the last 3, 4, 5 months, and I've trimmed them back dramatically because I just think that their stocks have gone up so much this year, and there's been this disconnect between revenue growth and stock appreciation.
Exactly. Yeah. I mean, Square comes to mind. I mean, yeah, it's a great company. There's no doubt. But at the same time, the valuation of that company is just insane at this point.
How about Fiverr? I mean, Fiverr's up like 700% this year. Revenues are up 100%, but the stock's up 700%. So, at what point does the revenue growth have to catch up to the valuation, or does the valuation have to decline to meet the revenue growth? And, you know, obviously you only get to a 700% appreciation on a massive multiple expansion. So, you know, maybe the multiple was too low before, and now maybe it's too high. And so I don't know if Fiverr has to trade at these levels for like 6 to 12 months to let the growth catch up, or if the stock's going to go down 30–40% to meet, you know, where that growth should, you know, where that growth says the valuation should be. So that's what makes me nervous about some of these growth stocks. Is I just feel like in 2021 you might see a multiple contraction. So I'm just taking some money off the table from the stocks that have had really big runs where the valuations feel really stretched, and putting that money or that capital into some of these new companies, not necessarily new IPOs, but some of these SPACs. I do love the SPACs because I think the SPACs are bringing some of these companies public that normally would not come public for another 3 or 4 years. And they're coming public sooner while they're still in this growth phase. You know, Airbnb, DoorDash, all these other companies that came public. I mean, well, especially DoorDash. I mean, DoorDash just, I mean, they were one of the ultimate beneficiaries of this pandemic. Right. I don't know. I mean, the growth that they saw this year, they can't replicate. There's no way they can replicate it. So you know, growth is going to start decelerating, but we don't know by how much. And that's where it's just it's so hard to value a company when growth is decelerating. Right.
Because I mean, right now, like, you know, if I wanted to go, if I wanted to just even have DoorDash come to me from Wendy's or McDonald's, I can do that. But when things open back up, I mean, I would want to go out to a restaurant. I would want to go out to eat there. I don't want to have DoorDash come to my house and bring me food, you know? So I can't imagine that kind of growth even continuing. I mean, or even a fraction of that growth. I mean, I would think if anything at all, like there has to be a deceleration in business next year at that point, if things open back up.
So restaurant owners hate DoorDash. I don't know if people realize that. They hate DoorDash.
They take 30%, 30 to 40% of your revenue just like that.
Which is basically your entire profit margin on just food. Right. So if you have to pay for all the overhead of, you know, the rent, the payroll, everything, and you have to give up 25 or 30% of the revenue, you're not making money on that order. I mean, you're literally only providing that food to pay your overhead expenses. That's it. I mean, you're just paying expenses. You're not putting any extra money in the bank. You know, you're not making money on liquor or anything else. So, I mean, these restaurant owners are dying for this pandemic to be over so they can get back to, you know, indoor seating and open up the bar and serve booze and all of that. So, I mean, I know DoorDash. I mean, I actually used DoorDash last night to get some sushi. And when you go on there now, you can actually order from CVS and Walgreens. So, I mean, they are getting into other, you know, niches, I guess, in the food space. So I guess they're trying to be like an entire delivery platform. But I don't know. To me, the valuation already feels just insane. And I just think there's too many companies out there with way more reasonable valuations and more upside over the next couple of years.
And it makes me think, like, is the human race getting that lazy that they can go out to CVS or Kroger to buy their own groceries or buy their own?
I mean, so I understand it for certain people. I mean, if you're a family of 4, right, and you have a couple kids and, you know, you don't feel like putting the kids in the back seat, I mean, it is easier to get delivery at some point. But yeah, I mean, we're definitely a lazy generation. I mean, I'm sure plenty of millennials, you know, they don't want to stop playing their video game. They'd rather just order DoorDash and have it show up at their door than have to pause the video game. So, yep, we are that spoiled and that lazy. And then other stocks I've gotten into, you know, some international e-commerce companies, because when I invest, I try to look at certain trends that I think are, you know, it's in the very early stages. You know, so that would be e-commerce, digital payments, alternative energy or EVs, electric vehicles, cannabis, of course, sports betting, right? Because I do think that over the next few years, as more and more states find themselves in a big budget hole, they're not going to have any choice but to start legalizing cannabis and sports betting to bring in those tax revenues to help fill that budget hole. And some of the biggest states out there still haven't approved one or the other, or in some cases both. So, you know, I'm not going to go crazy and overload my portfolio with those types of stocks, but I do think if I'm running a growth portfolio and looking to maximize my performance over the next 6-12 months, then I need to have exposure to those, those types of industries. So I do own a couple in each.
Perfect, perfect. I know you got to get going here soon, so I'll throw out some rapid fire questions for you.
Celtics are probably getting pounded anyways, so.
So what was your biggest loser of 2020? Which stock you're like, oh?
So actually they're only down 9-6. I didn't have too many big losers. So when I build my portfolio, I mean, so I own about 30 stocks right now, so I'm relatively diversified. I also do use stop losses sometimes to protect positions, whether it's a big gain or it's just so I have a big gain on a position, I'll use a stop loss to protect it in case some bad news comes out. If the stock drops 20%, I don't want to see 20% of my position disappear. Right. The other time I use stop losses, if it's a newer position and the stock has already had a nice rally, but you just don't know how much longer that rally is going to go before it pulls back. If I catch the rally in the middle, and I keep, and I'm riding it higher, I'll keep a trailing stop loss on there. So when it does start to pull back, I'm out with a profit, and I don't watch my profit disappear. Right. And then I think, I don't know, I'm trying to think. So Fastly was one of my biggest positions in the summertime. Right. And then the news came out that they might lose TikTok, because Trump was going to ban TikTok in the U.S. if TikTok didn't sell off its U.S. operations. Right. And TikTok was Fastly's biggest customer. So Fastly dropped like 30%, and I just thought it was way, way overdone. So I actually sold off like the bottom third of my portfolio and doubled down on Fastly. It maybe even triple down. At one point, I think Fastly got up to like 30-40% of my portfolio, which I would probably never do again. It was probably a little bit reckless, but I just had that much faith in the stock bouncing back, and it did bounce back, and it actually rallied from like the 70s up to the 130s. Now, thankfully, I was trimming the whole way up. So, every $5 that the stock went up, I would sell another, 5 or 10% of my position. So by the time the stock, dropped from 135 back down to 65 after the market found out that TikTok was 100% gone, right. I think the stock dropped. So it dropped like 40% in a week. And I think at that point, I trimmed it back down to about a 12% position. So even though I lost a ton of money, I'd already made a ton of money on the way up. So it was still like a net profit position, but I did take a bloodbath on the way down. But even with all of that and the other mistakes I made this year and trimming stocks too early, I mean, I was still up 290% as of this morning.
That's incredible. That's incredible. That's cool. So in 2021, so let's just say if some of these companies aren't going to see the type of growth that they've seen this year, what maybe top 2 or 3 names that you think 2021 stocks that can make it happen?
I would stick with Mohawk, right? Small cap company doing a lot of good things, selling in the e-commerce marketplaces, which, we all know Amazon's not going away anytime soon. So, and, the death of retail is a real thing. Brick and mortar is in trouble regardless of COVID or not. Everything's moving online. So a company like Mohawk, I still think a company like Celsius, which is a healthier energy drink. I call it.
What's your favorite drink, by the way? What flavor?
Oh, without a doubt, it's the blueberry pomegranate.
All right.
Yeah, that's the only one. I will admit that Bang. So Bang is another energy drink company. I think Bang overall, their flavors are better, except they're way more artificial and there's way more other crap in there. So when I drink a Bang, I get like a big spike and then I get like a bad crash. And I don't get that with Celsius. It's like just a much smoother, cleaner, boost of energy. So, but the blueberry pomegranate is phenomenal. So I mean, I think going forward, I am going to stick more to these, these companies that like 1 to 10 billion market cap, maybe with a couple smaller ones in there. Another one I really like is, let's see, so BarkBox, actually. I just did a write-up earlier this week. So the ticker symbol is STIC. That's a SPAC that is merging with BarkBox to take BarkBox public. So BarkBox is a subscription delivery service for pet owners for their dogs. So when they started the company 8-9 years ago, they were basically doing the subscription service, but they were just packaging these boxes with other companies' products and services.
Right.
So the margins were really crappy. But over the last 5 and 6 years, they set up their own manufacturing process. So now they design all their own stuff, they manufacture all their own stuff. So the margins are much higher, right? So 60% margins, they're growing at 40-50%. They do subscription services for treats, for toys, for dental services. So they have what's called Bark Bright, which is their doggy teeth cleaning stuff. I just think it's a really interesting company. It's only, I forget what the market cap is. I think it's like about a so I think it's about a $2 billion market cap with $500 million in cash. So about a $1.5 billion enterprise value. So and Chewy, right? Everyone knows Chewy.
Right.
Chewy's a $45 billion company. Growth is going to start slowing for them. Their margins are like 20%. So, BarkBox is like less than 1/10 of the size, growing twice as fast with 3 times better margins. Like I just think that's a better business model and, gives them a lot of upside potential. So stocks like that. And then a new one I got into today. So 2 that I got into today. One is called Upstart. So this company was founded by 3 employees from Google. And it's an AI-powered loan, like an underwriting, like a software-powered underwriting program or system, whatever. So what they, like the typical underwriting, the banks when they're doing underwriting for consumer loans or auto loans, they use FICO scores, right? Which is like just a number based on who knows. Now these guys created an AI-powered, model that looks at like 1,000 different data points from all across your life, social media, like all kinds of stuff. And these banks license that software or technology to power their own underwriting process. And the banks that use their AI-powered software have a 50% lower default rate than if they're using the standard FICO underwriting process. So 50% is a massive difference. So
huge. Yeah.
They're starting to get all the big banks signed up with them. It's a $3 billion company. The company IPO'd about a month ago at 20. It's already at 40. So it's already had a nice run. But I think as they continue,
what's the ticker on that one? You said
it's UPST.
UPST. Okay.
Yeah. So I literally just got in it today for the first time. I hadn't even heard of this company up until a couple weeks ago. I've been doing my due diligence on it, and I just think they have a big runway ahead of themselves, especially because, up until now, they've just been doing consumer loans, and now they're going to start getting into auto loans and mortgages and other types of, underwriting. So, and that's just, that is a massive, massive industry. And if you can help these big banks, cut their default rate by 50%.
Yeah, that's massive.
Massive. So, and then a company called Tattoo Chef, which makes
that's been on a run lately.
It has. So that's the challenge is these companies, they come public via SPAC. They still have a smaller market cap. They still have a lower float of stock. So, sometimes they can run up pretty quickly, and then you do have to worry about a pullback. But I think for now, the story makes a lot of sense, and I would rather own if you want to be in the the vegan food space, I would rather own a company like this than a company like Beyond Burger or Beyond Meat.
Right.
The valuation on this one just makes a lot more sense.
Yeah. Well, then does it worry you that what was that one company that had just amazing growth in its stock, but then just plummeted down nothing? Blue
Apron.
Blue Apron, yeah.
Yeah, so they were doing meal kits.
Yeah.
So the problem with that one was, I mean, that was a subscription service.
Mm-hmm.
And a lot of people, like they were paying so much money to acquire their customers,
Right.
and customers were just canceling the service after a month or two. So there just wasn't a lot of retention. So if you're spending $100 to acquire a customer and then the customer cancels after a month,
Right.
I mean, you're losing money on every single customer, and that's basically what was happening. It was just a bad business model. I mean, Tattoo Chef, I mean, you can order off their website. So I mean, there's an e-commerce component there, but they also sell in large grocery stores all over the country, and they're landing more and more of these retail partners. So, I mean, I think Americans are trying to eat healthier, but most people are not going to make their own cauliflower pizza.
Right.
Or, so the fact that Tattoo Chef makes
You said you had one of those pizzas, right? Did you like them?
Oh yeah, I like them. So I think I actually like the cauliflower pizzas more than a regular pizza. Cause like I don't know, I'm not a big crust person. So the cauliflower pizzas, it's a much thinner crust all the way around, and it's not quite as filling. And like, I do have a slight gluten intolerance. So the cauliflower pizza doesn't bother me at all versus, when I eat regular pizza, sometimes my stomach doesn't feel that good because of all the gluten. So for me, it works. For me, I love it.
Yeah, that's awesome. Couple other non-investing questions. Any tips on improving your max bench press? This is a member. He likes to work out and he wants to know how can he improve his max bench.
Oh God. I don't know. I mean, that's hard. It's, without actually working out with someone and knowing like what their body type is and how often they go to the gym. So I go to the gym 6 or 7 days a week, usually for an hour and a half every morning before the market opens, or sometimes in the middle of the day. If it's kind of a slow day in the markets, I'll put in a bunch of limit orders and then go to the gym. So I do chest every 5 days, I think it is. So I have so like tomorrow will be chest day. The next day would be shoulder or back, and then shoulders, and then legs, and then back to chest. Sometimes a rest day between legs and chest. But man, I don't know. I mean, first of all, I mean, you got to get your rest. You got to get your protein. And you gotta, I mean, if you want to improve your bench, you have to lift hard, you have to lift heavy. So, typically you're not going to grow and get stronger unless you're really pushing yourself to the limits, which means that you do need to probably have a spotter, because, if you want to grow, you have to, literally push yourself to the limits, and you're not going to be able to do that without someone helping you get those last couple reps up. So, I mean, that's typically when I see the most growth and the most improvement is when I have someone helping me get those last couple reps. So, because you get stronger and bigger by tearing your muscle fibers and then allowing, giving them the protein and the rest they need to, to build back bigger and stronger. So
awesome.
That's tough.
Those are some good tips. I appreciate it. And I'm sure he does too. This is a question from a couple female members. Are you single?
Yes.
All right, there we go. So yeah, this was a lot of fun. So the last question I have for you is on the SPX next year. You think, what are we looking at? 10% growth, 0, negative 10?
So what's funny is, so I popped on CNBC this morning and they said something like the last, it's been 3 down days in the market. I honestly didn't even know it was 3 down days because I had 3 awesome days. So it's funny, like when you're running your own portfolio and you're just focused on your stocks, you don't care
about the indexes.
You don't even pay attention to them. You don't even know what they're doing unless it's a really bad day. Then maybe you're paying attention to the overall broad market. But I would even have to look and see where I'm not even sure. Okay, so like let's just say percentage terms. Yeah, I think probably if I had to guess, I'd say somewhere 12 to 15% for the Standard & Poor's. But I think on the upside, I think with as the economy rebounds, as the job market rebounds, as more stimulus gets out there, rates stay very low. I think it'll be a positive year. I mean, I don't think it's gonna be like a 30 or 40% year. So I would say low double digits, but that's the broad market. That's the big companies. I think for guys like me and guys like, all of us that are doing this ourselves, and, we have more discretion over the types of stocks that we can own. I think if we do stick to those, I do think there's plenty of ways to add alpha to your portfolio, whether it's, investing in some of these higher growth companies, but don't chase them, wait for them to pull back a little bit and find some better entry prices. Don't chase Peloton at 165 or whatever it is,
Exactly.
like that's going to get you in trouble. Fastly, Cloudflare, all of these stocks are due for a correction. So
Right.
don't feel like you have to chase them right now. Try to find some bargains or sit in cash, or do something that one of my buddies recommended is, rather than sit in cash, which earns you jack, buy some of these low priced SPACs that have not announced a merger yet. So most SPACs raise money at $10 a share. So for anyone that doesn't know, so SPAC is a special purpose acquisition corp, or I think it's corp. And it's typically like a really well-known entrepreneur or investor, gets one of these SPACs. It's usually underwritten by one of the big investment banks, and then the investment banks help them raise the money for it. Maybe it's 300 million, 400 million, 500 million. Bill Ackman just did one at 4 billion, which is insane. But normally they're in like that 300 to 600 million range. And then that company can go out and use that cash to make an acquisition of a private company and take them public via reverse merger with the SPAC. So this is how DraftKings came public. This is how a lot of those smaller, betting companies, EV companies, cannabis companies, they're either have already come public or they're on the way of becoming public. BarkBox, which I just mentioned, another one of my stocks is called Weedmaps. It's SSPK. So Weedmaps is like the Google/Yelp for the cannabis industry. So that's just a different way for me to play the cannabis industry, where I'm not betting on a brand. I'm not betting on the grower. I'm not betting on the seller. I'm betting on like the search engine for the entire industry.
I see.
So these are companies that are still growing really fast, 40, 50, 60%. And normally they would go to their VCs and raise money and stay private for another 3 or 4 years. And we wouldn't get to touch them until they were coming public at 6, 7, 8 billion. And now we get a chance to buy into them at like 1 or 2 billion. So I love it. And what you can do, instead of parking money in cash, is buy some of these SPACs that are being sponsored by some well-known, respectable entrepreneurs that are most likely going to go out there and make a really good deal. And once that deal is announced, that SPAC is going to jump from 10 or 11 up to 13, 14, 15, 16, whatever. And, you can make 20, 30, 40% without even trying. So one of the SPACs that I'm in right now, it's HAACU. So this is a SPAC that was raised by the founder of Livongo. So Livongo, is a health monitoring company that sold to Teladoc for $18.5 billion this summer. As soon as that deal closed, Glenn and his team left Teladoc, which is not a great sign, but they left it to start this SPAC and go out and make an acquisition. So I'm in that one right now. I don't know if they're going to do a deal next week or next month or the month after, but I trust them to go find a really great company to take public. And as soon as they announce that deal, that thing is going to fly probably 25 or 30%. So in my opinion, there's no reason to sit in cash right now. There's no reason to sit in bonds. Get out of bonds, get out of CDs, get out of treasuries, either be in equities or sit in SPACs and wait for those deals to happen.
Yeah, that's a great tip. Man, those a lot of good stuff for sure. Did you get into Open Door through IPOB?
No. I mean, I owned IPOB a little bit over the last couple months, but
because that one almost not almost. I mean, that pretty much tripled by the time it got to Open Door, and now you've got IPOC that's going to be going to was it Plover next month?
Yeah, I think so. Yeah. So, I mean, look at DraftKings. DraftKings is a $50-something stock right now. At one point, that was a $10 SPAC at one point. So, I mean, I'm just trying to think. Yeah, I mean, there's been a lot of these SPACs. Obviously, Chamath has done a bunch of them, right? Open Door. What was his IP? What was IPOA? I I forget.
I can't remember for some reason. Well, there was, yeah, well, he did Desktop Metal, but I think that was something else. That was through another.
That was a pipe. Was that a pipe? I think that was a
Yes,
pipe.
yes, yeah, it was.
Yeah. So
I don't know what IPA
was
was.
it? And then there was MP Materials, which I'm actually into.
Yes.
Which
yeah,
is
that's
so that's another interesting one. So MP, I believe it stands for Mountain Pass. This is a a mine somewhere out in the Midwest. I want to say Montana, but
they do the rare earth.
correct. So
Mining.
so as more companies, like Apple, say they're going to get into electric vehicles, or Ford and GM, push harder on the electric vehicles. A company like Rare Earth, MP, with their rare earth materials or minerals, is going to make a killing. As those companies either get blocked from buying in China or just start to buy from U.S. suppliers instead. So
yeah.
But yeah, this has been, I think there's like 200 SPACs that are out there that are either in the process of merging or haven't even merged yet. So
200? Wow.
Yeah,
I didn't know there was that many. Wow.
Yep, a ton. So I think next year, 2021, I mean, it's almost here, but you're going to get a lot. You're going to get a bigger dose of these SPACs,
Interesting, yeah.
which I like, right? Because I have no interest in buying Google. I have no interest in buying Apple or Microsoft or these big mega 700 trillion dollar companies. I just don't think there's a lot of upside, right? I mean, so maybe Apple goes up 20 or 30% next year, but if Apple's going up 20 or 30%, I guarantee my growth stocks are going up at least that, if not more.
Right.
So if you're going to make money in those mega caps, if they're going to drive the market higher, everything else is going higher with them, I promise.
Right. Yeah. Interesting. Well, cool. Thanks, man. I appreciate you coming on. We'll have to do this again at some point in the near future.